Stocks climbed today after a weaker than expected jobs report gave investors reason to believe the Federal Reserve may be done raising interest rates, at least for now. The latest US employment data came in below expectations. Fewer jobs were added than forecast, and that single data point was enough to shift market sentiment meaningfully. When the labor market shows signs of cooling, it takes pressure off the Fed. And when the Fed feels less pressure, traders start pricing in a less aggressive path for interest rates, which is generally good news for stocks. Here is the basic mechanic at work. The Federal Reserve raises interest rates to slow the economy and bring inflation down, but when the economy is already slowing on its own, as a soft jobs report suggests, the case for additional hikes weakens. Investors read that as breathing room. Equities moved higher as a result. The rate sensitivity here is real. Higher interest rates make future corporate earnings worth less in today's dollars. They also push investors toward bonds and other safer assets. So when rate hike fears ease, money tends to flow back into stocks, particularly in growth sectors where valuations depend heavily on low borrowing costs. Bond markets moved in the same direction. Treasury yields fell as traders priced in a less aggressive Fed. That is a typical reaction. When fewer rate hikes are expected, demand for existing bonds rises, and yields, which move opposite to prices, come down. Lower yields then provide additional support for stock valuations. It is worth keeping some perspective here. One jobs report does not settle the debate on monetary policy. The Fed has been clear that it is data dependent, meaning it responds to what the numbers show over time, not to any single print. Officials will want to see a consistent trend before pivoting away from their current stance. A single soft month of hiring shifts sentiment. It does not guarantee a change in policy. The Fed will also be watching inflation data closely. If prices remain sticky, even as the labor market softens, the calculus becomes more complicated. Central bankers do not move on jobs numbers alone. Consumer spending, business investment, and inflation readings all factor into their decisions. What comes next matters as much as what happened today. Upcoming inflation reports and any public remarks from Fed officials will be the next test of whether today's market optimism is justified or premature. The practical takeaway: when economic data surprises to the downside, markets often rally on the expectation of easier policy. But watch the full picture. One data point rarely tells the whole story, and the Fed will need more evidence before changing course. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.